Today we're going to take a look at options income. When you think about options analysis, especially with the advent of weekly options, weekly expiration, which you really shouldn't treat any different than monthly expiration for that matter. But when we talk about that, most people they go too small. The time frame or the interval, the data that they're analyzing is too short. They're looking at intraday charts. There's conflicting indicators. Things move drastically, especially during options expiration week. And so they have a lot of difficulty getting consistent. So what we're going to talk about today is we're going to use the weekly. It's the weekly time interval. Okay, so it's weekly analysis. And what I teach my students to do is find the confirmed weekly breakout. Now, the great thing about the confirmed weekly breakout is it's one level. It's just one level that you have to master. Now, what's interesting, when that level is tested properly, analyzed and tested properly, you generally have an 80% chance that at the end of the week, price will be greater than that particular level. It's extremely probable. Okay, so that's going to be the main impulse for this selection of options. Okay, so which is our weekly level. So what that's going to enable us to do is, as we do always, is we can build a risk game around that, where we have 1x risk, and then theoretically unlimited upside potential, 5 to 10R, or however we're going to develop the risk game. And what's really, really important is right around where we're structuring, in this case, we're going to structure our option strategy. Okay, we actually have a qualified institutional technical level between where price is currently and our risk window, meaning that price is statistically unlikely to revert to that risk window. Very, very important that you do that, because most people do not. And so when they set up any type of strategy, none of this is in mind, and in most cases, they've just reverted to luck. All right, so what we're going to take a look at is, what does this look like? So just to quickly recap, if you want to watch the other options videos about how to select the proper contract, you can check the link in the description below. So what this looks like is, first of all, remember, for our long leg, we're going to want our slightly in the money 65 delta, and we want to put time on our side. Okay, so that's going to be our lead. And obviously we want this to be inexpensive too. So we want historical volatility to be high compared to implied volatility. Okay, so that's going to be the leap, which is down here. Okay, our not necessarily a leap, but we're going to call it our long-term option. Now for our short leg, our short sale, because we're going long here, then here we want the near month contract. And we also want that to be expensive. So we're looking for historical volatility to be much higher than, or rather implied volatility to be much higher than historical volatility. So just a quick recap on that. So what we're going to do is, let's just say, to get it started, to make it really, really simple, we're going to assume that these are shares of ABC stock here. Okay. So we're going to start with, the easiest thing to do would be your covered call. So it would be to purchase X number of, let's say 1,000 ABC stock at the weekly breakout. And this is going to be, we're going to assume that this is $35 our breakout. Okay, so 1,000 ABC at 35. Now what we're going to do is, depending on how we want to do this, we could do weekly expiration, or we could do monthly expiration, doesn't really matter. But if you analyze your weekly level properly, then you can go week to week. All right, so what we're going to do then is we're going to sell. So we purchased 1,000 ABC, and we're going to sell 10, okay, of the near month 35 or $36 calls, depending on where the price is. Okay, so we're going to sell those. So that's a 1-for-1 spread. It will not make money as high as it goes, but because your stock is obviously at parity, it doesn't matter how high the stock goes. Now, if the price dips back somewhere around your breakout or 4 or 5% below that, but we're going to statistically set that up so it does not likely to happen, we're going to have an 80% chance of this closing over, then we're still probably going to end up somewhere slightly in the money. Okay, so that's the easiest, most conservative approach. The next way would be to take, assuming we're at $35, we're going to do slightly in the money call. So we'd be looking at it would be somewhere in the 33 to 35, 2 to 6 month calls out. So for example, it's March right now. We'd be looking at May or June. Okay. Or if we're looking at the weekly, we want to go at least 3 weeks out to 1 month out to avoid the wasting asset cycle, or we would go somewhere in the 33 to 35, at least 3 weeks out for the weeklies. Now, the curious thing about this is there's a potential to roll these. So for example, if we do buy, let's say 4 weeks out, and these expire worthless of price right around our breakout, then we can sell the following week. So this is something that you can do. You can do sequentially 1 week after another by hanging on to the long. So the long gets held, and then you continue to put the shorts on top of that. Now, what you're going to have to do with this is, let's assume that we have 10 of these. Okay. So we're going to have 10. Now, we're going to have to do what's called a ratio calendar, because we're setting this up that prices are moving up. We're more likely to get price expansion than stagnation here because of the way we're setting this up. So in order to make this work, if we own 10 calls, we're going to sell just 7 of the near month. And when we're looking at, these could be probably the 36 expiration or 36 strike price. Okay. So we're just going to sell 7 for every 10. And so what happens is, because our delta down here is probably roughly 65, this no matter how high the price goes, this spread will make money. So again, very, very low risk because of the weekly breakout. So that's how we would set up a calendar debit spread. Okay. Now, for your credits, which I don't do because of the inverted risk skew, but you can. So what we're going to look at is, here we would be looking at basically selling the puts. So it would be the bull put spread. So what we would do is we would sell 10 puts and then come down to, let's say this is 35, come down to 33, and then we would buy 10. So we would sell 10 of these, and we would buy 10 of the 33s. That sets up our credit. All right. We keep the difference. So if we sell these for $5, cost $3 to buy these, we're up $2 per contract. Okay. Which is roughly going to be like $200. Okay. And then price ends the week higher or the month higher. That net credit we keep. So that's going to be your credit. Again, very, very low risk because of the weekly breakout. So that's how you want to establish your risk game. Always taking a qualified institutional level, putting it between your risk and the current price action. And that's an excellent recipe for long-term consistency, whether you're directional trading or you're looking to generate weekly or monthly income. So if you really want to learn how to do this, I teach people all the time. You can sign up for my webinar. The link is below. If you're having trouble getting consistent, I work with students frequently to help them achieve consistency, achieve their goals. Trading is not difficult. The industry just makes the learning process extremely difficult. So tune in next time for another exciting episode. My name is Frank Bunn. Thanks a lot and have a great day.